Hello, everyone, and welcome back to another episode of Stock Savvy, a series where we investigate an individual stock on the JSE. And every week we are joined by an expert guest. This week we are once again joined by Josh Viljoen. He made a lot of money with Argent. It seems like everyone made money here except for myself. I missed out on this one, unfortunately. So, Josh, would love to know, why did you make money? Why did you invest in the stock? And is there still a runway for maybe a little bit more money to be made? But before we get to that, welcome to the show. And you know the drill. Argent 101. Go for it.
Thanks for having me back, Paul. Yeah, good to be back for a second time. Sorry to hear that you were apparently the only person in Twitter that didn't make money off Argent. I guess everyone loves to post all the success stories and not when things are going badly. But yeah, let's get stuck into Argent. So I guess to kick it off, let's speak about what does this company actually do? Who is Argent? So if you look at Argent's annual report, they describe themselves as a steel-based benefication group. So if you don't know what benefication means, which when I first read that word, I did not know either, benefication is essentially the process of adding value to ore by removing unwanted materials. So essentially they're taking iron ore and they're removing unwanted materials and adding value. So that's how they describe themselves. But Argent are actually much more of a manufacturing business than a steel trading or mining business. So most of their operations and their value comes from manufacturing. So they have a broad range of subsidiaries. I think in total they have 26 different brands or businesses that fall under the Argent roof. I'll touch briefly on some of the types of products you can expect to come, I guess, from Argent's companies. It's anything from security gates, like your slam lock gates you may have. I guess security is a big issue in South Africa, so I think that's a big market for them. So things like security gates, window shutters. One of the more interesting businesses they have is actually aircraft refueling systems. So those little vehicles that come up to the planes and actually refuel the planes. Argent manufactures those. Other things like braais and fireplaces. I mean, it's another good braai. So braais, things like ladders, trolleys, cranes, fuel storage tanks, mining equipment, fencing, construction machinery, things along the line of that. So very metal heavy manufacturing. So they operate in South Africa as well as the UK and the USA. So they operate in 3 regions: SA, the UK, and the USA. And just a bit about the company and the strategy. So they are vertically integrated, and I think that is one of the value drivers, which we'll touch on later. So a lot of the cost savings, for example, that they can harness in their steel trading, they can then pass that upstream to their manufacturing businesses. So I think that's just a brief rundown of Argent 101. I don't know if you have any questions, Paul, that the listeners might have just about the business as a whole.
Yeah, I'm quite keen to get into this. Maybe you can just elaborate, because I know a big theme that they also mentioned in their yearly report was the move away from South Africa and then into UK, because they called South Africa a little bit of a fun show in the report. I'm like, wow, that's pretty much out there.
Yeah, so the CEO was very, very transparent in his wording. He didn't beat around the bush. So the intent is, I think, for management to not necessarily sell off the SA operations. I guess we'll see whether that is the case. But in terms of acquisition opportunities for now, it seems like they're only looking in the UK. And in terms of their acquisition strategy, they are focused on valuation. So they don't want to overpay for these businesses, and they want a business that's going to yield a high return on equity. So high ROE at a good valuation. And yeah, so they have listed some challenges of operating locally in SA, but I guess we can touch on that maybe when we speak to the bear case of the company and the risks around Argent. But that's a good point to bring up. They are definitely focused more on now investing into more stable and domestic markets like the UK, which I think is actually a positive for the share.
I see. Right, so let's get into the core of the business. So you've mentioned briefly what they actually do and the value additions. What are the key value drivers for this company? What makes this company tick?
Cool. So key value drivers for me looking at Argent. The first thing, and I think this is probably, if anyone had to have one takeaway, it would be this. This is their headline earnings growth. So on a 5-year basis, they've been able to grow headline earnings at an annual rate of 31.55%. Now, that is very impressive and something very few companies can have been able to do. Even throughout COVID, they were still growing earnings, while most businesses were not even operating or had a huge downtick in earnings. Argent was still growing earnings and over 30% annually. So I guess when you think to where share prices move, generally share prices are going to track earnings per share, because your share prices are dominated by what analysts expect earnings to be and what earnings actually are. So if a company is growing earnings, generally you're going to see your share price track that. And that's kind of been exactly the case for Argent. So their share price has essentially done 30% a year, just in line with HEX. So while it may seem like Argent has done amazingly well this year, the share price running up 30%, that was kind of just moving in line with their profits. So I wouldn't even say it was an overreaction from the market. The share price has still kind of tracked earnings, so consistently year on year. So I'd say that's the key value driver for me. Then some other things to note, I guess, given that they are a very asset-heavy manufacturing and industrial business, net asset value is also quite an important indicator that I would look at. And this has also grown consistently at over 15% a year. So that's another good thing to note. Then when it comes to revenue growth has been steady, but it has been quite low, especially when you compare it to your headline earnings. So like I just mentioned, earnings are growing at 30% a year, but when you look at revenue growth, they are only actually growing revenue at 7.5% a year. So I guess we'll unpack a bit later why revenue is only growing at 7.5%, whereas earnings is growing at 30%, because I think that is a very important thing to note in the Argent investment thesis. But that being said, while revenue growth has only been 7.5%, if you look at global averages for the manufacturing industry, Argent have surpassed this. So the industry hasn't been growing at 7.5%. The industry's been quite flat or showing very low single-digit growth. So when you look at the 7.5% in that context, it's actually quite good. So I think that's another important thing to note. And then another value driver for me is that management are excellent at controlling costs. So they must be very frugal and cheapskates, because while their revenue is going up, costs are coming down. So they're very efficient at controlling costs, which is something I like to see. Even in this high inflation environment, they're still able to actually keep costs low while driving revenue. So I think that's just a testament to this strategy of vertical integration, that they can actually source materials internally and transfer those cost savings upstream, like we mentioned earlier, to their respective manufacturing businesses. So yeah, I think those are some of the key value drivers. Looking at their balance sheets, also very robust. So they have a current ratio of 2.8. So for the listeners that aren't familiar with the current ratio, it's basically what is the ratio of your current assets to your current liabilities, and that essentially is a good measure of the liquidity of your business. So anything generally above 1.5 is seen as quite good, and they have consistently been well above 2, and it's currently at 2.8. So for me, that's a big check on the balance sheet side, so very happy there. And then on the balance sheet, they also have very small amounts of debt, so very low geared business, and they've actually been deleveraging the business since 2020. So I guess management must have had some insight maybe that we are going to be seeing a interest rate hiking cycle in the years to come, which obviously did happen. And while that was happening, they were making the prudent choice to delever the business and delever the balance sheet. So I think that's also been a big contributor to that earnings growth, because they're not paying high finance costs, so they can actually just transfer all those earnings straight to net profit.
Cool. So the balance sheet, that's always for the listeners, that's always a point of concern, especially for small cap companies, and especially in a recession, because having debt in a recession with high interest rates is always a disaster, and many companies have actually really, really felt this. So not having debt or very little debt is an amazing positive, in my opinion, in the current macroeconomic cycle. It is interesting, though, for a company that keeps on expanding like they are now doing and moving into the UK, that they're not acquiring new debt to expand? So they're acquiring businesses with cash that they already have on hand. How do they do this?
Yeah, so a lot of the acquisitions have been through the cash that they generate. I think the business is highly cash generative, so they don't actually at the moment need to raise debt on the balance sheet for investment opportunities. But I think there has been a bit of a slowdown, I guess, from Argent's side. They aren't aggressively acquiring businesses at the moment, and I think that just speaks to the current state of the market. I guess maybe management haven't identified that many opportunities for new acquisitions, and that kind of speaks to their capital allocation. So instead of acquiring businesses, they're actually paying down debt, like we said, they buying back shares, they're paying out a dividend. So I think that just kind of speaks to opportunities in the market at the moment, and maybe management haven't identified anything at a fair price that they're willing to pay at the moment that's going to yield those returns. So I think they are being quite prudent and being patient, and maybe not playing all their cards at once and kind of biding it out and waiting for those opportunities to come to them instead of just chasing the market and making acquisitions willy-nilly and overpaying. So as a shareholder, I mean, it's sometimes you have to be patient, and sometimes doing nothing is I guess the best thing to do when it comes to investing.
Right. So let's get to, I really want to hear about what you said. Oh, they're not really growing revenue, but they have massive earnings per share growth. So that comes down to the cost. I assume we'd love to hear more about that. Let's speak about the bull and bear cases. You can actually mention that first and then move into your overall bull scenario and then your bear scenario as well.
Cool. Well, like you mentioned, why are earnings growing at 30% and revenue is only growing at 7%? So that actually falls under my bearish argument. So let's start there. So I guess a concern from my side is that, is this earnings growth actually sustainable, and where is this growth coming from? So the first reason for this earnings growth is coming from share buybacks. And essentially, if you think about how your earnings per share is calculated, it's basically your earnings at the top of your fraction divided by your weighted average number of shares outstanding, or just think of it the number of shares the company has in issue. If the earnings at the top is staying the same and your number of shares is reducing every year, that total fraction is actually going to get bigger. So a lot of this growth is coming through share buybacks. So that's not necessarily a bad thing, because clearly it's working and it's effective, but it's not necessarily sustainable forever. You can only buy back so many shares, and that does kind of place concerns around the liquidity of the share. If they keep buying back shares, is there actually going to be sufficient liquidity in the markets with the number of shares that are actually going to left to be traded? So it's a concern, but if you're a long-term investor, share buybacks aren't necessarily a bad thing. You just, every year, you're actually owning a bigger piece of the company. So depending on how you view it, it's not necessarily a bad thing, but it's not indicative of sustainable organic growth. It's growth through efficient capital allocation. So that's one of the reasons where the growth has come from. Another one of the reasons is, and if you actually look at their statement of other comprehensive income, you'll actually see that one of the line items they have is foreign exchange gains, and they had a nice 16 billion rand forex gain this year on total other comprehensive income of 290 million. So 60 million of that 290 actually came from the devaluation of the rand. So that's another reason of where this growth is coming from, is actually from the rand weakening. So while that's not a bad thing, it's good to have stocks that are rand hedge. It's just important to understand that if you don't think the rand is going to keep devaluing forever, this might actually impact the growth the business is seeing, because that's where part of this growth is coming from, is from the rand actually devaluing. And then, like we mentioned earlier, we're speaking about the debt. So when you pay down debts, obviously you now have less interest expense coming through on your income statement. So that's also been a big contributor, but you can only pay down your debt to a certain extent. Once you have no debt, there's no more savings that you're going to benefit. So Argents are almost at that point. They only have like 95 million rand of debt left on the balance sheet, and they have over 250 million in cash, so they can easily pay this down. So the incremental savings they're going to get from paying down debt is kind of, they've almost tapped the end of that well. So you're not going to see these large interest savings coming through anymore, because they essentially always have no debt. So again, not a bad thing, but is this 30% going to be sustainable into the future, given that they're not going to have the same debt saving coming through year after year? That's another question to have. And then the last reason I noted for this high earnings growth was slightly revenue growth. It wasn't as big of a contributing factor, but also something quite interesting to consider was their effective tax rate has actually come down slightly. And the reason for this is that their foreign operations are starting to contribute more profit of the total, I guess, pie. So more profit is actually coming from the UK and the US, who actually have lower corporate tax rates. So I think that's contributing to this lower overall effective tax rate and contributing slightly to higher earnings. So that's kind of why this company is able to grow their earnings at 30% when revenue is only going up 7%. And then I guess the last reason, which we did touch on in the beginning, is cost savings. So their revenue this year went up again, but if you look at their cost of sales, it actually came down. So they're controlling costs. But again, is that sustainable? You can only lower your costs so much. I guess if you think about it in your personal life, like you can always, you can only save so much money, but the only way to grow your net worth is actually to earn more money. You can only save X amount. You can cut out that morning coffee, but how much is that actually going to save you forever? You actually need to grow your earnings income to actually generate more wealth.
I see. That was brilliantly explained. Thank you so much for that. So I guess, like you say now, it seems like it's not sustainable. Share buybacks, interest payments, all of those that you mentioned will probably, it can maybe continue for maybe 1 more year, maybe 2 more years, but it's not sustainable. So we have to increase and grow the revenue. Now, we're in a bear market at the moment. You said the industry as a whole is not growing. Do you feel like there is a way for, if the economy recovers and in 2024, 2025, we see the revenue growth? Or do you not see that? Because if you not see that, then the share price is most probably going to remain stable.
Yeah, so like we said, whether 30% is sustainable forever, probably not 30% earnings growth, but I do think the management have indicated that they are going to keep buying back shares. So for the foreseeable future, we probably will see share buybacks continuing to contribute to that earnings growth. And then in terms of actual revenue growth, I think where the key driver is going to come from Argent is if they can identify these niche investment opportunities offshore and make acquisitions at a fair price. So yeah, some of these businesses are quite robust. If you think about, for example, like aircraft refueling systems, it's not a sector where there's a lot of competition. And if they can find these niche businesses where they can have sort of a monopoly or oligopoly on these niche businesses, then they can definitely increase revenue through acquisitions. And they've shown the ability to do that in the past. So I think it'll just ultimately come down to where the management can identify these opportunities. And the CEO has indicated in his commentary that offshore earnings have been strong, and he continues to see this for the foreseeable future. So I think that does add some comfort that the year ahead, their offshore earnings are probably still going to be strong again.
Interesting. Josh, let's summarize the bull and bear cases and move on to the next segment. Let's just get it on paper.
Okay, cool. So we've touched briefly on the bearish argument. So to give a quick summary, my key concern as an investor in Argent would be, is their earnings growth sustainable? Given that the growth hasn't come from revenue growth, I think investors should ask themselves, is this growth sustainable, and what can we expect from this earnings in the future? I think if the business wants to grow revenue more than they have done already, this ultimately is going to come from making acquisitions. So bear case in a nutshell, is earnings sustainable, and can they actually make acquisitions to grow revenue? Then summarizing the bullish argument. So firstly, management are very efficient capital allocators, and they care about shareholders. So they are buying back shares when the shares are undervalued, and they're paying dividends when they don't see opportunities, and they had the foresight to actually go and pay down debt before the interest rates hiking cycle. So they are efficient capital allocators, and they actually have shareholders' interests at heart. So for me, that's a big tick. And then next, like we mentioned, a lot of their profits actually come from more domestic markets like the UK and the US. So it's offering a rand hedge in your portfolio, which I think is important for diversification. If you have a lot of SA Inc. stocks, it's good to actually have some stocks with offshore earnings to actually diversify in case the rand devalues as we've seen it has. Then lastly, they started upping their dividends and paying quite a nice dividend. So the yield's currently sitting at around 6%. And then just to emphasize this, look at their headline earnings growth. It's been amazing. A lot of people think Argent is a value stock, and it is. But if you look at the growth, I mean, some growth companies aren't growing at 30% a year for the last 5 years. So you're getting that value and that growth. So I think for me, that sums up the bullish arguments.
Yeah, I love that because that plays perfectly into the next point is, are they a growth company or a value company? Because they're trading at a low valuation, PE of 4. Who wouldn't say yes to that? But then you also get 30% year on your earnings growth. So I guess the big question here is, and this is a question we get a lot for stocks like Santova and Argent, it has now already pumped a lot. Does the stock still have legs? And this is where valuation comes into play. So the floor is yours. Is it a buy, or do I trim my position and then invest in other opportunities?
Cool. So for me personally, if I had to rate Argent between a buy, a hold, or a sell, I would probably put it as a hold. I am a shareholder and I have no reason to sell. I mean, the results were great. And the share price has moved in line with earnings. So for me, it's continuing with my expectations that the share price should move in line with the earnings. So for me, I have no intention of selling. But that being said, I'm probably not going to be buying into these levels just because I guess there has been a lot of upwards momentum in the share price. So I'd rather wait for it to cool off a bit, wait for some potentially negative sentiment to just pick up the shares on maybe a bad trading day. So for me personally, that's what I'm going to be doing going forward. And yeah, like you mentioned, incredibly low valuation ratio. So price to earnings ratio of 4.3. So incredibly low. Price to free cash flow of under 5. So for me, in terms of valuation, I don't see their actual multiples re-rating much lower than this. If anything, I think a catalyst for Argent could be, given that we mentioned management wants to kind of invest more offshore and less in South Africa. If you look at shares in more domestic markets, they typically trade at much higher multiples than SA markets. So if Argent can actually position themselves no longer as the South African company, but as a company with predominantly UK earnings, then why should they trade at a multiple of 4 just because they're listed on the JSE? Maybe they get themselves a secondary listing and they actually change the narrative from being this SA Inc. stock to where their earnings are actually starting to come from, which is the UK and the US. So I think that could be a catalyst for some value unlock, is if the market actually comes to the realization that the stock is actually getting most of the earnings from the UK and the US. Why should they trade at 4 times PE? So maybe you start getting that growth in earnings and your actual PE value multiple starts to re-rate upwards. So I think for me, that could be the potential catalyst for growth in the future.
I see. Very interesting. So that's yes, I'm holding, but I'm looking for opportunity on. So yeah, so let's leave it at that. I think we've made, a lot of people have made some money. I'm pretty proud of Hugo also, because Hugo puts his neck on the line. He says Santova is my biggest stock, Argent is my second biggest stock, and let's see what happens. And both of them panned out quite nice. And I also like that from you. For those of you who don't know, Josh is also very active on Twitter and he posts some really cool insights. So we really encourage you to follow me on Twitter. Josh, any last words, or are we leaving it at a hold for now?
Yeah, I would leave it as a hold. I would say if you are interested in picking up some Argent shares, maybe just watch the price closely and look for a potential opportunity to pick up some shares. But at the current price of a PE of 4 and a price to be cash flow of under 5, I have no problem buying shares at these levels.
Everyone, thanks so much for listening. Just this next up is I'll keep it a surprise, but it's a bigger company on the JSE. It's one of the top 20 biggest stocks, and I'll keep the guest a secret as well. Thank you, everyone, so much for your support, and until next time, cheers.
Cheers. Thanks for having me.